Best Loser Wins: Why Normal Thinking Never Wins the Trading Game by Jim Paul and Brendan Moynihan is a book that explores the psychology of trading and investing. Here are 10 main points from the book. 1. Traditional thinking about trading and investing is often based on faulty assumptions, such as the idea that the market is always rational. 2. Emotions play a significant role in trading and investing, and they can lead to irrational decision-making. 3. Fear of loss is a powerful emotion that can cause traders to make poor decisions, such as selling too early or holding on to losing positions. 4. Successful traders have a different mindset than average investors. They view losses as an opportunity to learn and grow, rather than a failure. 5. The key to successful trading is to develop a system that is based on sound principles and that you can stick to even in difficult times. 6. Discipline and self-control are critical to successful trading, and they can be developed through practice. 7. Risk management is an essential part of trading. It involves understanding the risks associated with each trade and developing strategies to minimize those risks. 8. Trading and investing require continuous learning and adaptation to changing market conditions. 9. The most successful traders are those who can control their emotions and maintain a level head in both good times and bad. 10. It's important to have realistic expectations and to avoid chasing after get-rich-quick schemes. Instead, focus on developing a sound strategy and sticking to it over the long term. Point 1 in Best Loser Wins: Why Normal Thinking Never Wins the Trading Game refers to the common assumption that the market is always rational, and that investors and traders make rational decisions based on all available information. The authors argue that this assumption is often flawed, and that human emotions and biases can cloud judgment and lead to irrational decision-making. For example, investors may become overly optimistic during a bull market and make rash decisions based on euphoria, or they may become overly pessimistic during a bear market and make decisions based on fear. The authors suggest that it's important to recognize the role of emotions in investing and trading, and to develop strategies to manage these emotions in order to make sound decisions. This involves understanding the common biases and heuristics that can lead to irrational thinking, such as confirmation bias, hindsight bias, and anchoring, and developing techniques to counteract them. By doing so, investors can improve their chances of making sound decisions and achieving long-term success in the market. Point 2 in Best Loser Wins: Why Normal Thinking Never Wins the Trading Game highlights the role of emotions in trading and investing. Emotions are a natural part of being human, and they can play a significant role in the decision-making process. In the context of investing, emotions such as fear, greed, and hope can lead to irrational decision-making and cause investors to make mistakes. For example, fear can cause investors to panic and sell stocks at a loss, rather than holding onto them and waiting for the market to rebound. Similarly, greed can cause investors to take on excessive risks or invest in assets that are overvalued, leading to potential losses. Hope, on the other hand, can cause investors to hold on to losing positions in the hope that they will eventually turn around, rather than cutting their losses and moving on. The authors of the book argue that successful traders and investors are able to manage their emotions and make rational decisions based on sound principles and strategies. This requires self-awareness, discipline, and a willingness to learn and adapt. By doing so, traders can avoid the common pitfalls of emotional decision-making and increase their chances of success in the market. Point 3 in Best Loser Wins: Why Normal Thinking Never Wins the Trading Game highlights the power of fear of loss in trading and investing. Fear of loss is a natural human emotion that can cause traders and investors to make irrational decisions, such as selling too early or holding on to losing positions for too long. When investors experience a loss, they may feel regret, disappointment, and frustration. These emotions can cause them to make impulsive decisions that are not based on sound reasoning or analysis. For example, a trader who experiences a loss may panic and sell their position too early, rather than waiting for the market to rebound. The authors suggest that traders can manage their fear of loss by developing a sound strategy that includes risk management techniques, such as setting stop-loss orders and diversifying their portfolio. By having a plan in place, traders can avoid making impulsive decisions based on fear, and instead focus on making rational decisions based on their strategy and analysis. Overall, managing fear of loss is a critical aspect of successful trading and investing, and traders who are able to control their emotions and stick to their strategy are more likely to achieve long-term success in the market. Point 4 in Best Loser Wins: Why normal thinking never wins the trading game suggests that successful traders view losses as an opportunity to learn and grow, rather than as a failure. This mindset is different from that of the average investor, who may view losses as a negative experience that should be avoided at all costs. The authors argue that successful traders are able to learn from their losses and use them as an opportunity to refine their strategy and improve their decision-making. Rather than dwelling on their mistakes, successful traders focus on analyzing what went wrong and how they can avoid similar mistakes in the future. By doing so, they are able to continuously improve their trading skills and increase their chances of success in the market. This mindset also involves recognizing that losses are an inevitable part of trading and investing. Even the most successful traders experience losses from time to time, and it's important to be able to manage these losses in a way that minimizes their impact on overall performance. By viewing losses as an opportunity to learn and grow, traders can maintain a positive mindset and avoid becoming discouraged by short-term setbacks. Point 5 in Best Loser Wins: Why normal thinking never wins the trading game highlights the importance of having a well-defined trading plan. A trading plan is a set of rules and guidelines that a trader follows in order to make consistent and disciplined decisions. The authors argue that a trading plan should include specific criteria for entering and exiting trades, as well as rules for managing risk and controlling emotions. By having a clear plan in place, traders can avoid making impulsive decisions based on emotions or market fluctuations, and instead focus on making decisions that are based on their strategy and analysis. A well-defined trading plan can also help traders stay on track and maintain a long-term perspective. Rather than getting distracted by short-term fluctuations in the market, traders can stick to their plan and make decisions that are consistent with their overall goals and objectives. Overall, having a well-defined trading plan is an important aspect of successful trading, and traders who are able to develop and follow a disciplined plan are more likely to achieve long-term success in the market. Point 6 in Best Loser Wins: Why normal thinking never wins the trading game suggests that successful traders have a deep understanding of market dynamics and the factors that drive prices. They are able to analyze market trends and patterns and use this information to make informed decisions. In order to develop this understanding, successful traders typically engage in ongoing research and analysis, and use a variety of tools and techniques to gain insights into market trends and patterns. This may include technical analysis, fundamental analysis, and market sentiment analysis. By having a deep understanding of market dynamics, successful traders are able to identify potential opportunities and risks, and make informed decisions that are consistent with their trading plan and overall objectives. This allows them to make trades with confidence and avoid making impulsive decisions based on emotions or short-term market fluctuations. Overall, a deep understanding of market dynamics is a critical aspect of successful trading, and traders who are able to analyze market trends and make informed decisions are more likely to achieve long-term success in the market. Point 7 in Best Loser Wins: Why normal thinking never wins the trading game suggests that successful traders are able to manage their emotions effectively, and avoid making impulsive decisions based on fear or greed. Emotions such as fear and greed can cause traders to make irrational decisions that are not based on sound analysis or strategy. For example, fear may cause a trader to sell a position too early, while greed may cause them to hold onto a position for too long. Successful traders are able to manage their emotions by developing a mindset of discipline and self-control. They understand the importance of sticking to their trading plan and avoiding impulsive decisions based on emotions. This may involve setting specific rules and guidelines for managing risk and avoiding emotional reactions to market fluctuations. Additionally, successful traders are able to maintain a long-term perspective and avoid becoming too attached to individual trades or positions. They understand that losses and setbacks are an inevitable part of trading, and focus on making consistent and disciplined decisions that are based on their overall strategy and objectives. Overall, effective emotion management is a critical aspect of successful trading, and traders who are able to control their emotions and avoid impulsive decisions based on fear or greed are more likely to achieve long-term success in the market. Point 8 in Best Loser Wins: Why normal thinking never wins the trading game highlights the importance of risk management in successful trading. Risk management involves developing strategies to minimize potential losses and protect against downside risk. Successful traders are able to manage risk effectively by implementing a variety of risk management techniques, such as diversification, stop-loss orders, and position sizing. Diversification involves spreading investments across a range of assets and markets, which helps to reduce overall risk. Stop-loss orders allow traders to automatically sell a position if it falls below a certain price, which helps to limit potential losses. Position sizing involves determining the appropriate size of a position based on risk and reward considerations. Additionally, successful traders are able to manage risk by maintaining a disciplined and consistent approach to trading. They understand the importance of sticking to their trading plan and avoiding impulsive decisions that could increase their risk exposure. This involves setting clear risk management rules and guidelines, and adhering to them consistently. Overall, effective risk management is a critical aspect of successful trading, and traders who are able to minimize potential losses and protect against downside risk are more likely to achieve long-term success in the market. Point 9 in Best Loser Wins: Why Normal Thinking Never Wins the Trading Game emphasizes the importance of continuous learning and adaptation in successful trading. The authors argue that successful traders are constantly seeking to improve their skills and knowledge, and are willing to adapt their strategies and approaches based on changing market conditions. This involves ongoing research and analysis, and staying up to date with the latest trends and developments in the market. Additionally, successful traders are able to learn from their mistakes and failures, and use these experiences to refine their approach and make better decisions in the future. This requires a willingness to accept responsibility for their own performance and take a proactive approach to improving their skills and knowledge. Overall, continuous learning and adaptation are critical aspects of successful trading, and traders who are able to stay current and adapt to changing market conditions are more likely to achieve long-term success in the market. Point 10 in Best Loser Wins: Why Normal Thinking Never Wins the Trading Game emphasizes the importance of having a long-term perspective and focusing on consistent performance over time. Successful traders understand that trading is not a get-rich-quick scheme, and that achieving long-term success requires a disciplined and patient approach. This involves setting realistic goals and objectives, and focusing on consistent performance over time, rather than short-term gains. Additionally, successful traders are able to maintain a long-term perspective by avoiding emotional reactions to market fluctuations and focusing on their overall strategy and objectives. They understand that losses and setbacks are an inevitable part of trading, and are able to stay focused on their long-term goals and objectives, even in the face of short-term challenges. Overall, a long-term perspective and focus on consistent performance are critical aspects of successful trading, and traders who are able to maintain this perspective and focus on their long-term goals and objectives are more likely to achieve sustained success in the market. Thank you for your interest in this book. I would much appreciate if you leave your feedback on this book in the comments below or just put a like on this video. You can find links in the description of this video, where you can purchase and download this book.